The search for yield is on. The US economy could be facing a potential recession in the coming months, so yield is important. And in today's video, we are going to take a look at 3 dividend stocks that have dividend yields above 4%, and they appear to be trading at a great valuation. If you love dividend stocks, particularly high yield dividend stocks or even dividend growth stocks, do me a huge favor, click that like button down below, as that is huge for the growth of this channel and I truly appreciate it. With that being said, let's jump into the video. Hey everyone, Mark Rusin here, back for another video. As always, I'm a CPA and not a financial advisor, so please perform your due diligence before investing in any stock and do not take this as financial advice. And before we begin, let me take a quick moment to thank today's sponsor, The Motley Fool. The Motley Fool has a ton of great resources and tools for investors of all levels. And right now, if you go to fool.com/Mark, you could sign up to receive their 10 best stocks to buy right now. With that being said, let's take a look at 3 high yield dividend stocks that have yields above 4% and appear to be trading at great valuations. High yield dividend stock number 1 is Dominion Energy, stock ticker D. Dominion Energy, as you could probably guess, is an energy company that produces and distributes energy to more than 7 million customers here in the US. The company has a market cap of $46 billion, and over the past 12 months, the stock is down 33%. And on the year, they're down 12% alone. Utility companies are often steady as you go, slow growing companies, but Dominion operates in a regulated industry and operates in 16 states, but its primary operations are within the state of Virginia. So what has happened to the stock, you might ask? Well, rising interest rates, much like we have seen with many REITs that are out there, there's a lot of competition right now for high yield. You can get it from a utility company like Dominion, but you can also get high yields from high yield savings accounts or even T-bills right now, with how the Federal Reserve has increased all of this over the past 12 plus months. Given that Dominion operates within a regulated industry, they can only increase rates so much. And given how fast and how quickly interest rates have increased here in the past 12 months, they have been unable to pass a lot of that on to customers. And another thing that's weighing on shares of Dominion is that during Q1, management came out and gave really poor Q2 guidance, which spooked investors and was well below analysts' expectations. So when you put all of these things together, the stock has been under intense pressure. So why are we even talking about this stock, you might ask? Well, we are headed towards the end or nearing the end of this rate hike cycle. That's what a lot of investors believe and economists believe right now. And what I do on a weekly basis is I'm looking for high quality companies, as I'm a long-term investor. High quality companies trading at great valuations. That could be a great time to get in right now for long-term gains. And even though there are economic and regulatory headwinds right now for the company, Dominion appears to be trading at a great valuation, and we're going to look at that here in a second. One way I like to screen for stocks to look at, particularly dividend stocks, to look into further is by looking at their current dividend yield compared to their 5-year average. This could tell you, because remember, dividend yield is calculated based on the dividend rate and the stock price. If a stock price drops, inherently a dividend yield is going to increase. Over the past 5 years, Dominion has had an average dividend yield of 4.2%, and right now they sport a dividend yield of 4.84%. In terms of valuation though, look at just how low of an earnings multiple shares of D are trading at. Analysts are looking for 2023 EPS of $3.91 per share, which equates to an earnings multiple of just 14.1 times. Over the past 5 years, shares of Dominion have traded at an average multiple of 19.2 times. That is more than a 25% difference. The last time shares of Dominion traded at a multiple this low was in 2011. High yield dividend stock number 2 is Vici Properties, stock ticker VICI. Vici Properties is a REIT that operates within the gaming and hospitality sector with a huge presence along the Las Vegas Strip. The company currently has a market cap of $32 billion. Over the past 12 months, Vici shares are actually up 16%, and in 2023, shares are flat. Vici is known for being the largest landlord on the Las Vegas Strip. owning properties such as Caesar's Palace, MGM Grand, the Venetian, New York, and Mandalay Bay, just to name a few. In totality, the REIT owns 49 properties with 47% exposure to the Las Vegas Strip. Owning great properties is just one piece of the puzzle. You also have to have great operators, and Vici has just that. Vici is in rare territory, and if you look back over the global pandemic or during the depths of the global pandemic, many REITs were struggling with rent collections. Many REITs saw rent collections of 50% or less, even high quality REITs with the likes of Realty Income. Vici, on the other hand, saw 100% rent collections. This is all a testament to their high quality operators. And remember, with Vici being the landlord, they want to see their operators do well and perform well, but their main focus is collecting that rent check. So even if we dip into a recession and these operators maybe don't do as well as they're accustomed to, these operators are still likely to pay their rent because it's very difficult to move out of the likes of Caesar's Palace. Vici currently offers a high dividend yield of 4.7%, and over the past 2 years, investors have also enjoyed dividend hikes of 8.3% and 9.1%, which is an added bonus to an already high dividend yield. Vici has only been public since 2018, so investors are still working on what a proper valuation should be based on results, but the company continues to grow and expand at a nice clip. Analysts are looking for Vici to generate AFFO of $2.13 per share in 2023, which would be a 10% increase over 2022. This equates to a price to AFFO multiple of 14.9 times, and since going public, the REIT has traded closer to an average of 16.3 times. The drop in the multiple is not due to the stock price drop. As we saw at the start, the stock is actually up 16% over the past 12 months. So this tells you how their AFFO has been growing steadily over the years. I'm a big believer of Vici and the great portfolio and management team that they have, and I believe that multiple will be north of their average in a few years. High yield dividend stock number 3 is going to be a little bit controversial, and that is AT&T, stock ticker T. I used to own AT&T years back and sold it right around $30, and since then the stock has dropped mightily. The stock is trading today at $17. The company currently has a market cap of $122 billion, and over the past 12 months, shares of AT&T are down roughly 14%. Over the past decade, AT&T shares have fallen nearly 40%. This is a decade in which the S&P 500 climbed 150%. So really, it has been a lost decade for AT&T. They saw bad acquisition after bad acquisition, ballooning debt, poor management, and poor execution. The current CEO, John Stankey, took over the CEO position in July 2020 and has since oversaw the sales of a third of AT&T's stake in DirecTV for $16.25 billion, which is an acquisition the company made years back for $67 billion, including debt. Mr. Stankey also oversaw the spin-off of Warner Media to Discovery last year for $43 billion cash plus $59 billion in Discovery stock. AT&T paid $85 billion for Warner Media back in 2018. Mr. Stankey is not new to the company. He's been around and been with AT&T for a number of companies, which is something I was not all that excited about when he got promoted to the helm. But seeing some of this turnaround and how he's taking AT&T back to their roots is something that I'm getting a little bit excited about when it comes to this telecom giant. He is trying to right the ship by not only returning to their roots, but also paying down this mountain of debt they have generated over the past few years. Mobility growth, subscriber growth, as well as fiber growth were all great areas the company saw in Q1, all showing solid signs of growth. Debt is still my biggest concern when it comes to AT&T, but management expects to generate $16 billion in free cash flow on the year, which will help pay a big dividend, but also help pay down their big debt. You can see that in this chart here how the total debt amount had ballooned to over $160 billion, but with recent sales and spin-offs, they've been able to bring that number down to roughly $136 billion. Still a big number, but progress nonetheless. Management has a goal to hit net debt to EBITDA of 2.5 times by 2025. Right now, they're closer to 4 times, so still plenty of progress to be made there. In terms of the dividend, AT&T shareholders earn a yield of 6.3%. The dividend has been a hot topic for AT&T shareholders. Right now they are earning this high yield of north of 6%, but this is a dividend that was slashed nearly 50% just last year. This tells you how much pressure AT&T shares have been under recently. The question I get most when it comes to AT&T revolves around the safety of the dividend. If we look back at Q1, the company paid dividends of $2.1 billion. Now, dividends are usually paid from free cash flow, but AT&T generated just $1 billion in free cash flow during the quarter. This means that they had to dip into their cash position to pay out their dividend. This is not something we want to see from quarter to quarter. However, as we also stated, the company expects to generate on the back half and in totality $16 billion of free cash flow during 2023 as a whole. So definitely something to watch closely as the year progresses. Now on to valuation. Analysts are looking for 2023 EPS of $2.41 per share, which equates to an earnings multiple of just 7 times compared to their 5-year average of nearly 11 times. A pretty big gap there, and there is certainly plenty of unknowns. And this is likely the most risky of the 3 we look at today, but at this valuation and some of the turnaround we are seeing, it could be worth a second look. A lot of investors are not only looking for great valuations with the stock market right now, hoping a turnaround happens here at the back end of 2023 or early part of 2024. Timing the market is very difficult, but if you layer into high quality positions at great valuations, long-term investors will be rewarded. Let me know down in the comments section below which of these 3 high yield dividend stocks are you most comfortable with buying right now. Thanks again for watching. If you haven't done so, hit that like button down below, and we'll see you in the next video. Take care.